explain what you think is happening within this bond market and whether it's actually connected to anything fundamental or any particular catalyst whatsoever.
So let me give you a factoid. Just before Chair Powell spoke yesterday, the 10-year yield in the US had traveled 30 basis points up and down in the last 3 days on no major news. That is liquidity. And what you're seeing is that the deepest market in the world is having some, at the edges, liquidity strains. And we're seeing these outsized moves in yields. Now, people who've been in market for a long time are saying, keep an eye on this. This is interesting. Why, John? Because right now we've only talked about interest rate risk. We haven't talked about liquidity risk. We haven't talked about credit risk. All the focus has been on interest rate risk. And a really open question is, at what point does interest rate risk spill over into liquidity risk and credit risk? And that's something that we should be talking about much more and analyzing deeply.
Mohamed, let's do that now. What do you think is fueling that?
So I think the market is obsessed with interest rate risk right now, but growth is weakening. It is weakening all around the world, in the US, in Europe, in China. At some point, we're going to start wondering about credit risk. And then remember that you have a whole marketplace that has been conditioned by what remains very loose financial conditions. Let's remember that. Financial conditions, while the delta has been towards tightening, the absolute level for the US is still very loose. If that changes, which it will if credit spreads move, if equity prices move more, and if rates stay where they are, if that changes, then you've got liquidity risk in play as well. So that's the sequence. You know, John, I didn't want to be right on inflation. I didn't want to be right on the Fed being late. I don't want to be right on interest rate risk becoming also credit and liquidity risk, because then we are in a much messier situation than we are today.
Are there reasons to believe that you will be right on that? And what are those reasons?
I think the reason basically to believe that is that you may get a policy mistake, an even bigger policy mistake. And that by itself would turn interest rate risk into also credit risk and liquidity risk. So that's the reason. If you think the Fed is going to make a policy mistake, and the market is starting to signal that. I go back to the break-evens. I go back to what's been happening to the front end every time they speak. That's what you have to keep an eye on. That's the key judgment that you have to make right now.